Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken, and our model portfolio is up 32.23% year to date. We have a green for the stock market strength color signal, and we are beating the returns of the S&P 500 buy and hold investor by more than 5%, and we have triple-digit returns so far this year, year to date. So we are absolutely ecstatic with the performance of our model portfolio. Today's video, what we're going to cover is this video is for retail investors. We're going to do a deep dive into the technical analysis of the S&P 500. We not only show you the technical analysis, but we show you exactly how we trade our model portfolio to give you, the audience, the tips and tricks that you need to help enhance your own trading skills. I'm going to show you exactly why I make the plays that I make, the timing that I'm making the play, what's happening with the market at that time, and to show you where my thought process is at that moment in time to make a determination on how I want to make those positions. We're going to go over that information in this video. Also, we're going to review last week's trades. We're going to show you how the model portfolio is doing compared against the benchmark of the S&P 500, because we need to have a comparison basis. So we need to know how well we're doing in comparison. In addition to that, we're going to have a market summation with the closing thoughts on the next trades. Now, because I am not only going to show you my technical analysis, but I'm going to show you the exact trades and how the model portfolio trades with this strategy. I do not believe there is another YouTuber out there that actually does all of this content and the model portfolio and the trades and is 100% transparent. If you are aware of another YouTuber that shows their technical analysis, how they trade their model portfolio, and what the results are, the return on investment of that portfolio, drop me their link in the description down below so that I can review that person's channel. I don't know of another YouTuber that puts this much content packed into one video. Last week, the S&P 500 gained 1.67%. This is a weekly candlestick chart with the duration of 5 years. We use the SPDR's ETF acronym, which is SPY, and this is the S&P 500 in an ETF format. We still have a negative divergence outlined right here from the MACD compared to the price action during the same time period. This negative divergence will resolve itself as soon as the black line crosses above this blue resistance line. It has not done so yet, but it looks like it is ready to do it in the coming week. So if that's the case, this negative divergence will now be alleviated. Now, what else do we see in this chart? Up here, you can see ourselves in a rising wedge format, which could be a bearish pattern because you could come down like this. But right now we have not done that. This market is strong. It is moving forward, and the way that it looks right now, the way that I am observing it, it looks like we're going to be getting to the 600 mark. I'm going to show you that when we get to the daily slide. What else do we see here in this weekly chart? The slow stochastics is above 80 and positive, and the MACD is already positive right now and getting ready to break that negative divergence. That's about all I see on this chart. Now, one thing I want to point out, one last critical thing here. Inside candle. Last week's action on the S&P 500 was this candle, which is an inside candle. You'll notice that the body of this candle completely is enshrouded by the body of the previous candle. So to me, this current candle, last week's action, is an inside week, telling me that we're going to have sideways action for the following week until we break out. So I'm expecting some sideways action in the next short-term market action is what I am thinking looking at this chart. Okay, last week we did make 3 trades, and here are the trades right here. Now let's go through them one at a time. On the 18th at exactly 10:23 a.m. Pacific Standard Time, I sent out this to my subscribers. We want to sell to open 2 in-the-money covered calls. Why 2? Because we had 200 shares already and we're holding of SPY. So we're going to sell to open two contracts, in this case for the model portfolio. And the strike was 569. The expiration was 11/22/24. We didn't go out that far. We only went out till Friday. It's like a 4-day trade. And the premium that we were sellers, we sold it, we were able to get $20.12. Then on the very next day, 11/19/24, we sent this out to the subscribers. We want to leave our in-the-money covered call in place and also place 1 long call. So at this point in time, you can see I'm getting bullish. I'm getting more bullish on the market. I wanted to buy to open the 12/19/25. We went out an entire year on the duration. 650 was the strike, so way out of the money, and for about $19.39. Then, and that trade went out at 11:05 Pacific Standard Time. Next trade was on 11/20/24, the very next day. So I did 1 trade per day, 3 days in a row, Monday, Tuesday, and Wednesday. At 11:58, about 11 a.m., we want to buy to close our in-the-money covered call. Why? Because the market at this point in time was pulling back. I felt that the market was more bullish than bearish, and I wanted to be weighted towards longs on the model portfolio. So we wanted to buy to close it, and we bought to close the 569 strike, 11/22/24 expiration for about $17.89. So we bought it for $17.98. We sold it for $20.12. So we made some money on that in the money covered call, even though I was getting more bullish on the market. Generally speaking, I use my in the money covered calls in an effort to collect money when I feel more bearish about the market than bullish. I'm looking for market pullbacks. We've got that to me, an in the money covered call is we've got protection in place. When the market pulls back, then we know that in the money covered call is going to lose money compared to the price that we sold it at. So when we go to buy to close, we're going to buy it back to close at lower dollars, which is exactly what happened here in this very mild trading market action that we had last week. This is why the model portfolio is beating the returns of the S&P 500. I'm able to nick and gouge and manipulate into do and trade the portfolio in such a way that's conservative, but at the same point in time brings us in additional revenue. Okay, here are all the trades that we've made in calendar year 2024. The yellow represents trades that are currently open right now. Now, the trades that we were talking about are going to be right here at the bottom. So on the 18th, that's when I put on an in the money covered call, and I told you it was for $20, and I bought it to close at $17.98. Well, we made $428 on that trade. Yay for us. Our in the money covered call, our long call that we put on 11/19/24, today is 11/23/24, we're up $190, which is not bad. In this case, it is 9.8%. Excellent on a percentage basis returns, but only $190. That trade was $1,939 on the long call. We're going to leave that in place. I'm going to show you why we're going to leave that in place as we go through this video today. If you want to see how I trade this model portfolio on a weekly basis, I want you to smash that like button down right now, subscribe to my channel, and ring that bell to be notified when I post a new video. Now here is the equity curve of our model portfolio in blue, which is right here, compared to the benchmark of the S&P 500 buy and hold investor in pink. Couple things that I want to point out. Number one, the biggest thing, we are surpassing the returns of the S&P 500. Here are the exact returns. We're beating them by more than 5%. It's like 7% or there, approximately. In addition to that, I just want you to notice the slow, steady upward pull of my model portfolio. Not that many gyrations. This is what you're looking for in an equity curve when you want to compare yourself on other strategies and how volatile other strategies can be with their trading. Now we are looking at a daily 6-month chart candlestick for the S&P 500. Now, we were measuring the pullback, which is from this Fibonacci right here. Now, we grabbed that Fibonacci from here to here, and the market did pull back into the 50%. It never hit the 61.8, which is this line right there. It never hit it. It definitely hit the 50%. So we had a 50% retracement on the Fibonacci, not bad. And now it looks like we are off to the races. Now we are going to at least come to these old highs, or the expectation is we're going to come to these old highs. 600 is a nice round number. I fully expect the S&P 500 within the next 2 weeks to hit 600. At that point in time, I'm expecting possibly surpassing 600, but not by much, or moving sideways, or bouncing off the 600 and coming down. But I definitely see us tagging that 600 mark. What else do I see? I see that the MACD is below the signal line, but curled up and definitely getting ready to break above its signal line. Slow stochastics above its signal line and getting ready to go above 80. You can see it going right there. This chart is telling me that we have bullish activity. This looks like a low, just like that was a low right there. So that is what I am observing right now. I would not be surprised to see this even go to somewhere in the neighborhood of 610 before moving sideways and then moving down. That would be the upper end of the range. But I see it at least tagging the 600 mark without too much effort. Now we are looking at a ratio chart. This is the NASDAQ 100 against the S&P 500. The ratio chart is the chart that is in red and black. The S&P 500 is in blue. Blue is right there. And then in black, we have the NASDAQ 100 symbol QQQ right there. Now, generally speaking, on the ratio chart, when the ratio chart is traveling north, that is bullish for not only the NASDAQ 100, but also for the S&P 500. When it is traveling south, exactly opposite happens. What is happening right now? I do see that there was a trading range for the ratio chart, and we broke the support of this line, and we are currently we broke it, we came up, tagged the bottom of it, and then it got rejected and then came down off of it. There are two moving averages in here. The 50-day simple moving average and the 10-day simple moving average. Those are in red and green. And just for clarity, the 10-day is here and the 50-day is here. We are trading, or this chart, this ratio chart is currently below both moving averages. It's below the bottom end of the trend channel that it showed rejection off of. What does that tell you? The MACD is below its signal line and heading south. The slow stochastics has topped, not crossed below its signal line yet, but I expect it to cross below its signal line within 1 or 2 days. All of these things are telling me that this ratio chart is going to be traveling south. Now, technically, that means that the S&P 500 is going to be surpassing the NASDAQ 100, but normal healthy bull markets, you usually have the NASDAQ 100 also beat the S&P 500. So with the ratio chart heading down, even though the S&P 500 will surpass the NASDAQ 100, it still is not great. So it's still somewhat bearish for the S&P 500, the market that we trade in on this channel. So this chart, all in all, is giving a bearish tone for the S&P 500 for next week. Now we are looking at the VIX volatility or fear index, 3 ranges. Above this green line is the upper range bearish. Below this green line is the low range bullish. Below this green line is the ultra low range bullish. Where are we at? We are in the ultra low range. We spent an enormous amount of time in the ultra low range. We are currently in the ultra low range. And generally speaking, when you are in and you stay in the ultra low range, there's only one way for the S&P 500 to go, and that is up. What else do you got? You do have the slow stochastics topped, and it looks like it is now below its signal line and ready to head south. MACD bounced off of its signal line and is heading south. These things here tell you that there's not really a lot of energy for the VIX to travel north. Keep in mind, the VIX travels inversely to the S&P 500. When the VIX travels south, the S&P 500 travels north. What does all this tell me? This chart is telling me that we are in bullish. Next week is going to be bullish for the S&P 500. Now we're looking at seasonality for the S&P 500. We're currently in the month of November. This is a chart going back 5 years. 80% probability you're going to close higher than when you open the month. So this is the percentage of months in which the S&P 500 closed higher than it opened. And we're in the month of November. 80% probability you're going to close higher. Well, guess what? For the month of November, this is a monthly chart. The month is up 4.73%. But you only have to close 0.01% to be a positive month. So that means you're at risk by 4.72%. Now, one thing I want to point out on these monthly candlesticks, I do see a trading range. Here's the upper end resistance, lower end support. It looks like this month it bounced off of the support and it is traveling north, and it is somewhere in the middle. So it looks like it can go in either direction and still be completely within this trading range. So this chart is kind of telling me that we're at risk by 4.72%, but there's still upside to go. So I'm going to say overall this chart is telling me that we're neutral for next week's action. Okay, right now we are looking at a 3-year weekly candlestick chart on the Thinkorswim platform for the S&P 500 with standard deviations +2, -2 in gold, +1, -1 in pink. We have the 50-day simple moving average in green, and in black, that's the 200-day simple moving average. I have a couple of projections. I have an upper end projection here and a lower end projection right there. We are currently trading right in between my upper end and lower end projections here on this chart. On this chart, you can also see that inside candle because this is a weekly chart right now. And I do have a trend line I see here in this dashed red line, which I grabbed from this top, and I must have grabbed it from some other top further back here, going back more than 3 years. And we did absolutely tag that line and showed rejection and didn't penetrate above it. So, but the way I'm looking at the chart now, this here is a potential low, and we are going to increase. It's a little bit hard to say how much we are going to increase from looking at this chart. Let's go ahead and switch over and go to a 1-year daily. and change our cycle brackets to 1 year daily. Hang on. Daily cycle bracket. Okay. And what else do we want to see here? We want to see what is happening. Okay, you can see our standard deviations. You can see our cycles. And what else can you see on this chart? I got a red support line driven, put in at this low right here. So we definitely don't want to break that low, but we are in no jeopardy of that happening at this time. Kind of see something like that right there. Doesn't look like this trend line that I just put in isn't going to be broken. And it is what it is. It looks like we're just simply grinding up. Now, I got in here a 600 mark. I'm going to show you my trades in a second. Feel pretty confident we're going to tag that. And I wouldn't be surprised to see it go above, but the only question is how much above that 600 is it going to go before it starts pulling back. That's the only thing that we don't know the answer to. Okay, now we are looking at a spreadsheet that I created, and this is going to look at various asset classes as well as the 11 S&P 500 sectors broken down. And we want to determine the strength of how everything is doing. The highest number you can achieve is the number 6. So anything with a 5 or a 6 gets a green. Anything lower than that does not get a color. The more green on the screen, the healthier things are. Now, and we also want to compare last week's action to the current week for both the S&P sectors and the asset classes. Now, when it comes to the asset classes, we went from a 48 to a 49, which shows strength, but we still have yellow. But as soon as we get to 60, that yellow is going to change from yellow to green. So asset classes are looking stronger, definitely stronger than last week. S&P 500 sectors was 62, now 80. Definitely you have strength across your various 11 S&P 500 sectors. Now we are looking at the chart TNX, 10-year U.S. Treasury yields, candlestick chart. These are the candlesticks right here. S&P 500 is in blue right there. In black, now we have TLT, black right there. That is 20-year bonds ETF. Now, what's remarkable here is that the Fed is cutting rates, but during this time frame, the TNX 10-year U.S. Treasury yields have been traveling north and staying north. They are not pulling back down. I'm expecting them to pull back down, but they have not done so yet. They are sticky or resilient, staying on this upper end. That is not good for the S&P 500 and also not good for TLT. But if indeed the TNX 10-year U.S. Treasury yields begin to come down, you will see TLT take off like a rocket, and you will ultimately see that will help the S&P 500 as well. Okay, we do have a holiday for the New York Stock Exchange coming up in the weekly trading. Thursday, November 28th, for Thanksgiving Day, the market will be closed. All right, that is going to take us to our final closing thoughts. As of November 23rd, 2024, the market summation, according to me, Ken, your friendly host for Spy Trader Now. Looking at the weekly chart, we have an inside candle, which suggests sideways action to me for the next week. The daily chart pattern is suggesting up action because I see bullishness on that chart. The question now is, how do we play next week? We currently have 200 shares and 1 contract long call. You know my trades, I showed them to you earlier in this video. Now, I say we're going to keep our current positions and the below covered call. So keep the current positions and add this here. We're going to sell to open 2 covered calls. The strike price $5.98. Now the current trading is at $5.95, so it's slightly out of the money. So it'll give us a little bit of upside potential. It's below 600. It's a very reasonable target to hit. And we are going to get some cheese by taking this on. We're going to receive $374 in option premium, even if we are unexercised. If the market goes above our strike, 598, then we'll get some additional cheese, because we bought this even before the current market price of $5.95. I don't have it memorized how much we exactly bought it for, but we know it's less than $595, the current price of the the SPY. So we're going to make money if we get exercised, and even if we don't get exercised, we're going to make $374 to add to our model portfolio. So to me, this is a conservative trade to take on. We have plenty of cash right now available to us. So if indeed this market starts tanking and going south on us, we could put some puts on or something like that to protect ourselves. I don't even think that's going to happen. The market is showing bullish action in front of us. It doesn't look spooked. We saw the VIX. The VIX is in the ultra low range. The market has currently no fear. So with that, the market is going to grind slowly up. It's going to grind up because right now you don't have fear in the market. So I hope you got some valuable information out of this video. If you have not done so, I want you to smash that like button down, subscribe to my channel, and ring that bell. I thank you and wish you good trading.